Today, mortgage stress goes higher as cheap fixed rates end. Hello again, it's Martin North from Digital Finance Analytics, one that is post covering finance and property news. Well, I'm just running my month-end models and I can already see that mortgage stress is higher, and it's being driven by the move from fixed rates to variable rates as households meet that mortgage cliff. And in fact, Roy Morgan estimates that mortgage stress has risen to its highest level since September 2008. With 28.4% of mortgage holders now considered, quote, at risk, following 3.5% of interest rate hikes by the RBA. A borrower is deemed by Roy Morgan to be at risk when their mortgage payments exceed a predetermined threshold between 25 and 45%, depending on income and spending. If the RBA increases interest rates by another 0.25% next week, Roy Morgan estimates an additional 99,000 borrowers would experience financial stress, and a further 34,000 borrowers will experience financial stress if rates are lifted by another 0.25% in June. Now, Roy Morgan says that they adopt a conservative model, essentially assuming all other factors remain the same. Therefore, if there was to be a meaningful lift in unemployment, then mortgage stress would be higher than estimated. And it's worth noting that with more than 600,000 fixed-rate mortgages scheduled to expire over the 9 months to December 2023 across the Big Four banks alone, those fixed-rate expiries will see mortgage rates jump from around 2% to over 5%. So even if the RBA holds interest rates from here, Australian households will continue to come under increasing financial pressure due to the fixed-rate mortgage cliff. And in fact, the latest chart from the RBA's Financial Stability Review highlights the impact of this fixed-rate mortgage cliff. You can see here that scheduled mortgage repayments are forecast to rise to a record share of household income once the fixed-rate mortgage reset finishes. Mortgage rates have already risen beyond the 3% mortgage serviceability buffer, which is applied by APRA when these fixed-rate mortgages were originated. Therefore, it's likely that a large number of borrowers risk being pulled into the red once their fixed-rate mortgage terms expire. But I've also made the point, and I'll make it again, that just looking at the mortgage element of household cash flow misses the bigger picture. In our modelling, we also look at overall cash flow in terms of money out and money in. Incomes are still growing much slower than the cost of living. The inflation number was very strong, of course, when it came out. And therefore, the most technically accurate way of assessing what's going on is to do what we do, which is to look at money in and money out and then determine whether, in fact, cash flow is positive or negative. The fact of the matter is that both amongst the rental sector and among mortgage holders, negative cash flow is becoming more predominated. And for those with a mortgage, it's all about the fixed rate cliff plus the rising cost of living. For the renters, it's about rental reset and also the rising cost of living. There is little evidence yet that income growth is catching up, and in fact, people are worse off than they have been for years and years. Therefore, there would be no surprise to see higher mortgage stress ahead. The question then becomes, what happens? Will mortgage stress convert ultimately into defaults? Well, that's going to be determined by a couple of factors. Firstly, what the banks do. We're already seeing banks leaning over backwards, trying to find ways for people to make some repayments, if not all repayments. And then the other thing, what households do, because there will be a point at which households decide to cut their losses and sell and get out while they can. Now, we're not there yet, which is why I'm suggesting that the default rates will stay low for the next few months, but will slowly eke higher. And as we come into the middle of the year and beyond, I would expect to see some defaults beginning to flow through, but really defaults are an issue for 2024 and beyond. So I'll be updating my mortgage stress data over the next few days, and I'll make a show about that when I do. And in the meantime, everybody's saying, Roy Morgan and ourselves, households are even more under the gun than they were. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.